The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A reprieve on tariffs may have come just a bit too late as economic fallout mounts. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. We're kicking you off to the closing bell right here in New York. You would have thought we'd come in today, potential tariff reprieve, and we'd have a nice rally underway. And we did, but now we faded that. The S&P's only up by about 0.2%. Even the NASDAQ is well up its highs of the session. You're even seeing money coming into the bond market, usually a sign of a safe haven trade. And the dollar, though, continues that steady decline, though, down by about 0.5%. So it's where is that tariff relief, Romaine?
Absolutely. And really, we should point out foreign trade continuing to drive the financial market trade and the accompanying volatility along with it. Kudos to whoever made this graphic, because we started the year with the U.S. average tariff rate just above 2%, a tariff rate that surged to 26% in early April. And now, today, following the overnight court ruling, a rate knocked back down to 6%. Or is it?
This might be considered a body blow, but it's not the final rendering. And specifically, there are a number of other substitute acts that the Trump administration could employ to maintain tariffs.
That sentiment echoed by a lot of folks on Wall Street, including Michael Zizas at Morgan Stanley. But no matter, traders must now navigate yet another layer of complexity in this global trade dispute, the impact of which is already showing up in the economic data. Revised GDP numbers for the first quarter showing consumer spending slowed more than first estimated, and the slump in net exports, that was worse than thought too, subtracting the most from GDP on record. Interesting backdrop for Fed Chair Jay Powell, who was at the White House today for his first face-to-face meeting with Trump since he was sworn in as president back in January. A discussion on economic developments that included growth, employment, inflation. A surprise development, that meeting, in a year, Alex, that has been full of them.
Yep, definitely looking forward to more details out of that meeting. So you were talking about those export data as well as that GDP data. If you take a look at, well, these are the sectors that were layered. This is the U.S. Economic Surprise Index from Citi. That's that white line. So the higher it goes, the more positive economic surprises that we're seeing versus the S&P. It's over the last year, and you can see they roughly seem to track each other. Now, what we have seen recently is the U.S. Economic Surprise Index from Citi actually increasing, S&P along with that, which raises the question, Romaine, if we back out the tariff threats, we remove those kind of headwinds, does data continue to surprise to the upside, and can we retest those recent highs for the S&P?
Gargi Chaudhuri joins us right now, Chief Investment and Portfolio Strategist of the Americas at BlackRock, here in Studio 2. And that chart, I think, really illustrates kind of the complexity of where we are right now. You do have a lot of economic fears. You have an earnings season that actually, I think, allayed a lot of fears. And then, of course, you still have, at least based on this court ruling today, just that reminder that this uncertainty around all of this still exists. So how do you break that down?
Absolutely. Good afternoon. It's good to be here. Thank you for having me, as always. So you laid out the points really well. I think the first thing that we should remember is there was always that dichotomy, the divergence between the hard and the soft data. And we talked about that. And now what we're finding, perhaps, is that the hard data remains okay, which was always the case. And some of the soft data, and we saw that in the consumer confidence data earlier in the week, is actually rebounding just a little bit. And that, I think, is giving the market some confidence. We're also learning that there's quite a lot of reason to still, sort of expect a little bit of volatility in the market. So yes, the court ruling was perhaps, some would view that as a very positive thing. I would say that probably brings into question even more uncertainty. If you are a consumer, if you are a corporation right now, how are you supposed to make any decisions based on the fact that there might be other tariffs coming into place based on the Section 232 or 301? How should you make your purchasing decisions? So I think obviously remaining invested, but really focusing on ways in which you can diversify your portfolio remains key here.
But when it comes to equities, I mean, we're pretty much through the earnings season now with NVIDIA, kind of the last of the big folks out of the way here. And it was not as bad as I think a lot of folks feared, even some of the forward commentary. And I want to focus in on NVIDIA and what Jensen Huang talked about, because he did raise a lot of yellow flags when it comes to trade and China and export controls. But he also was very clear about the pace of corporate spending, CapEx spending, the investment in these more thematic areas of our market like AI, and he seems to say that that's still intact.
Yeah, absolutely. I think what we heard yesterday was sort of the tale of two stories of AI, where on one hand, yes, there will be that one big market in China, 50 billion, that may not be as accessible as before, and you saw that in some of the write-down. But on the other side, you have this this plethora of opportunity, not just in other regions of the world. So you think of Middle East and places like India and Malaysia as an opportunity for AI expansion. But you also then think about the second order effects. And, Jensen Huang talked about that with respect to where we are seeing more of that demand. So more reasoning models. And that was something that he focused on in his 4 points. And I think more AI infrastructure, data warehouse build out, which obviously we've all talked a lot about and BlackRock is focusing on. I think that is the next forefront of AI, and I think that was the second more important point that the market focused on yesterday.
Do we get new highs in the S&P this year?
I think it's hard to say whether we get new highs in the S&P at this moment because there's so many cross currents in the market, but I think what we've learned so far is that you're supposed to, number one, find places of diversification, and number 2, continue to remain invested. Can we see a pullback, especially given that we've had this rapid rally since April 9th, and I would say perhaps maybe a rally that many people were caught a bit off guard, and maybe we see a little bit of a pullback? Sure, we could see that, but I think there are pockets of opportunity. We think AI remains an area of the market that you should continue to invest in and put your money towards. I think international equities is an area of the market where most of the investors that we talk to, most advisors have a huge under allocation in. So bringing that back into your portfolio, we think makes sense. And then lastly, don't forget fixed income. I think rates are going to continue to stay higher for longer. So clipping that coupon in the fixed income markets remains really important.
Where overseas? So thank you. I just sneezed. So it was more geared towards Europe, right? And then there's also a lot of talk now about Asia ex-China and where that interest is. And there you got Japan, a very different story. Then you have Latin America also. Where are you seeing most of the flows?
Absolutely. So where we're seeing the flows and where we think there's opportunity. So we're certainly seeing a lot of investors continuing to focus in Europe. So that's a trade that's taking place. We're seeing that in the flows. And if, obviously that can continue to be another area of the market where especially people that have been under-invested, bringing their portfolios back just to market weight. And again, when you sort of think about what you're getting when you're invested in the US market, obviously you're getting that quality, you're getting that growth. So maybe focusing on Europe to get that value part of your portfolio. So EFA value, EFV is a ticker that we're telling investors to go towards. On the flip side, an area that investors are not thinking about at all and perhaps should is looking at LATAM as an opportunity. And obviously, we've seen some of the moves there this year already, but thinking about Chile and Mexico as opportunities that you may not have considered in your portfolio in the past, but that could be a big beneficiary of this regime.
I am curious, when we talk about the complexion of what's going on in the market, there's been a lot of talk, at least certainly on the U.S. side, about how retail investors have been driving much of the rally that we saw kind of in late April and into May, and that the participation on the institutional side has been a little bit less, at least less than historically what it would have been. When you looked at the reaction in the pre-market today, when we kind of thought the tariff thing were going to be on pause, and that 2% jump up, I am curious, is that retail doubling down, or is that the institutional folks finally realizing that maybe there is some safety back in equities?
I think it's hard to parse through why, in the overnight markets, why we got the reaction that we did. I think there were a lot of drivers. Obviously, the big one was around tariffs, but NVIDIA was a big driver as well. I think more and more as New York came in and as the US markets opened up and we had some volume and liquidity in the markets, what you recognize was what I laid out before, that there is still uncertainty. This does not wipe out all of the uncertainty, and tariffs still do remain the sectoral tariffs do remain in place.
And on that point, we should point out an appeals court has now weighed in on this topic, saying that they have temporarily halted that ruling by the Court of International Trade against the Trump tariff. So again, this would be a ruling now in favor of President Donald Trump and his tariffs. That appeals court saying that it will allow the Trump tariffs to stay in effect for now. So a temporary pause. Obviously, this is something that is going to be battled out potentially to the highest court in the land. Our thanks to Gargi Chaudhuri, Chief Investment and Portfolio Strategist of the Americas at BlackRock. Stick with us. This is The Close on Bloomberg. All right, it was just yesterday when a Manhattan-based trade court ruled that several of Trump's reciprocal tariffs are illegal. We have now learned that an appeals court has put a temporary pause on that order. Kailey Leinz, the co-host of Balance of Power, joins us now here in Studio 2. We did hear from the White House a little bit earlier saying that they did plan to appeal this case, and now an appeals court saying that they can stay in effect for now.
Yeah, because what was unusual about the CIT ruling that we got handed down from essentially trade-oriented judges last night was that they said the administration had 10 days to wind down these tariffs, that they were not going to allow them to stay in effect while the appeals process played out. The administration obviously immediately appealed that, and this appeals court is granting them the permission to leave the tariffs in place until there is a final ruling on this. And Caroline Leavitt, the White House press secretary, did say today that the administration's view is that the judge's decision last night was judicial overreach, that this administration does have legal authority to use IEEPA in this way, and they are willing to take this fight to the Supreme Court, which could in theory happen as soon as tomorrow. And it may be up to the 9 justices to ultimately hand down the ruling as to whether or not Trump is authorized to use these policies in this way, and whether or not these tariffs can stay in place on a permanent basis. But this is certainly a win for the administration, at least at this point, knowing that they were feeling quite confident about their legal standing going into this appeals court.
Yeah,
decision.
Peter Navarro speaking on Fox right now, saying the administration fully expected favorable ruling on tariffs. Even if this goes to the Supreme Court, there's still other tools in the toolbox, right, to impose tariffs? There
absolutely are. It's just a question of what authority you want to use and the amount of time you want to use to work through that process. So there's Section 232, which looks at national security concerns. He's opened those investigations already into areas like pharmaceuticals and semiconductors. They're already in place when it comes to steel and aluminum and automobiles tariffs. There's others in terms of Section 301, which looks at unfair trade practices, investigations that could be launched there as well. And he does have IEEPA authority granted to him by Congress in the 1970s. It's just a question of what exactly authorizes an economic emergency or justifies an economic emergency and the use of tariffs in this way. But it really is just a matter of what reasoning the administration wants to use, what process they want to go through, not necessarily can they implement a tariff, but what grounds do they implement that tariff on. Again, the reciprocal tariffs and the tariffs on fentanyl will be able to stand thanks to this appeals court intervention, at least for now.
All right, Kailey, really appreciate that. We'll continue to follow these headlines for you. Bloomberg's Kailey Leinz joining us there. Taking a look at the S&P, not that much movement. The VIX still firmly staying at around 19. Again, it goes to Gargi Chaudhuri's point about there's just more uncertainty, even if you wind up blocking and then reinstating and blocking and reinstating. The uncertainty continues, and commodity markets definitely do not like uncertainty. Joining us now is Natasha Kaneva, head of global commodity strategy over at JPMorgan. Natasha, what has been the effect so far in the commodity market? Let's just zero in on oil for a second on the tariffs that have already been in place.
Thank you for having me. Well, actually, not that big of an impact. Actually, so far, everything what we're observing in the oil market is that demand has been resilient. Year to date, we're averaging about 1 million barrels per day. It's hard to say how much of that was the cold winter in the first quarter, how much of that is front loading. But overall, demand so far has been resilient. I just came back from China, and actually the feedback from the Chinese, especially in the Chinese copper and aluminum and metals manufacturers, the demand is very strong, 6 to 7% growth in the first quarter. They don't believe that there's that much of a front loading, and they believe that there's enough momentum to carry it through the end of the year.
So the demand side feels relatively okay. Then it's the supply side, and we heard the news today that Kazakhstan is going to keep wanting to produce oil despite its agreement with OPEC Plus, and OPEC Plus continuing to put more barrels into the market, which we should confirm on Saturday during their meeting. Are we oversupplied?
Well, we are oversupplied, so it's very visible. We see the increase, the OPEC increase. We see this now in the export data. We see this in the Brent-Dubai spreads, but we also see this in the sharp increase in the inventories. Since February, inventories increased by about 160 million barrels. That's about 1.5 million barrels per day. What is interesting is that the prices have been actually very resilient. If you look at the WTI and Brent price, it has been very resilient. We do expect another supply increase from OPEC in July, but what is interesting is that we estimate that after that, actually, majority of the OPEC producers, with the exception of Saudi Arabia, will be producing at close to their capacity. So Kazakhstan is one of those countries, but they use UAE, Iraq, and some of the other smaller producers. They will be pretty much flat out, which means that there is a very strong price floor to the price at around 55 Brent, 50 WTI.
So 55 Brent, we're around 64 now here. Is there anything, do you see any scenario to the upside where we could be looking at something greater than where we are today?
Well, it's a great question just because we're getting a lot of pushback from clients. And so one of the feedback is that the prices are $10 too low. Some clients are saying that actually they're $20 too high. The optimistic or the bullish argument comes from the fact is like, listen, we have all this inventory building, we have OPEC increasing production, but look at the price structure, look at the price, it's very resilient, look at the margins, look at the cracks. So far, everything has been very resilient, so meaning that, price should be trading higher.
Even though we're looking at prices now that are not profitable for new drilling for U.S. shale producers, for example, we just heard from Chevron that they're laying off 800 workers in the Permian. We don't know how much of that's related to the current price versus their planned 20% decrease in the workforce. But what's the rig count going to look like? What the trickle down is going to look like?
They will be declining. So in our numbers, we estimate that the true, the bare bone break even in United States shale industry is about 47 WTI. That assumes 0% return on investment. So what that means, especially with our price forecast, if indeed we're going to stay at around 55 WTI, that's about 80 rigs gone between now and the next 12 months.
Do we get there? Do we get there?
That's the forecast.
So we do get to 47. What happens after 47?
No. Oh, do we get to 47?
Yeah.
No, we don't have this price forecast, but we have 55.
All right. Well, I am curious, too, how this sort of folds into just the overall economic conditions as it relates to some of the concerns about tariffs. And we were talking the other day about kind of this relentless rally that we continue to see in haven assets like gold.
Yes.
And I am curious if there is sort of a yin-yang to maybe what we're seeing in other parts of the commodity space like oil and what we continue to see in precious metals.
Well, so the precious metals, this is the trades that did not start today, yes.
Yeah.
So we put a buy recommendation in November 2022. At that time, gold was trading at 1,700. We thought it can double. So there were many different drivers, but one of the main drivers was, there was a completely new buyer emerging, and that was the World Central Bank. And just to put a number there, historically, they were buying about 400 tons of gold a year. In 2022, they bought 800. In 2023, 1,000. In 2024, slightly over 1,000. The main impetus for that, in our opinion, was the U.S. Treasury deciding to freeze Russia's foreign assets. There was $300 billion. Only 5 of that was actually located in the United States. The rest was in Europe, in Brussels, and even then the U.S. Treasury was able to do that. So the world central banks concluded that maybe it's time to start diversifying, and that's what they're doing. Right now, we have a third buyer emerging. It's most likely foreign investors that are holders of U.S. assets would start diversifying from those assets. $57 trillion as of the end of last year is currently held by foreign investors. If 0.5%, half percentage point of that goes into gold, in our estimate, gold can double from the current levels to $6,000 by 2029.
Wow. Is that your base case? Or what's your percentage of that?
So we estimate that actually by the end of the Trump term, so the end of 2028, early 2029, we can get there, yes.
All right, Natasha, always a fascinating, and I think every time we have you on, there's always a wow moment that comes out of you. One of the smartest folks on Wall Street, Natasha Kaneva, head of global commodity strategy at JPMorgan, as we continue to count you down the close with the refocus back on equity markets and our top calls, the big movers on the back of analyst recommendations. And we want to start off here right now. We're going to take a look at Southwest Airlines. Deutsche Bank upgrading that stock to buy from hold, raising the price target to 40 from 28. The analyst seeing a number of tailwinds out there for the airline and says they have confidence that the management team over there will execute its transformation plan with, quote, considerable success. Those shares getting a nice bid, up about 2% on the day, 3 straight days of gains. Next up, Starbucks moving in the opposite direction. TD Cowen downgrading the coffee chain to hold, maintaining a $90 price target, though, with the analysts saying that customers are passing on another cup of joe, causing a delayed return to normalized same-store sales that would only be exacerbated in the event of an economic downturn. Those shares down about 2%. And finally, Salesforce. RBC lowering its recommendation to sector perform, slashing the price target all the way down to $275 from $420. Despite reporting results last night that beat expectations, RBC says that there is still execution risk in Salesforce's acquisition of Informatica. Those shares down about 4% on the day. And those are some of our top calls. We do now want to turn to another big mover on the day, and that is Best Buy. Those shares down about 8% after the electronics retailer lowered its sales and profit outlook due, well, to the impact of tariffs. Best Buy also admitted to making some tariff-related price increases given their exposure to China. Kate McShane joins us right now, Managing Director in Global Investment Research at Goldman Sachs. She's got a buy rating on Best Buy. All right, let's start off with the tariff commentary, Kate, and particularly in light of the uncertainty today, because I really thought what they said on the conference call was very revealing. This idea of the uncertainty, the idea that not knowing what's around, and that in their view, they're basically going forward with a model that assumes that the tariffs that are in effect today will, in theory, be in effect tomorrow. Is that also in your model?
Yes, it is. And I think that's what we're hearing from, frankly, most of the companies that have reported earnings so far, is that what we know today of the tariff landscape we know today is really what is baked into these companies' models. The risk is, of course, is if anything changes, which it could, because we know that we're only on temporary stays here, both with the reciprocal tariffs and with Chinese tariffs. And so at the end of the day, this is the best that the companies can really guide us to, is knowing what the tariff rate is today.
How much pricing power does a company like Best Buy have?
So I think the first reaction when you think about what Best Buy sells, which is consumer electronics mainly, is that it's discretionary. But on kind of further reflection, if you think about how much you use your laptop for work or education, or your tablet or your phone, I think that discretionary piece starts to fall into something a little bit more defensive. And so I think when it comes to computing and tablets, there's going to be a lot less of an elasticity response there if prices were to go up. I think, other sectors of consumer electronics that are still considered discretionary, like gaming, would probably be a little bit more sensitive to higher prices.
Confession, guys, I don't have a laptop.
What?
I don't. I do not have one. I just use my phone. Oh. Just putting that out there. I know, it's kind of weird. Kate, okay, so I have two parts to my question. The first one is, the outlook was better than feared. Normally when we get a better than feared scenario, the stock goes up. So why is it down?
Well, I would say that there are two things as to why it's down. First is the same-store sales number they reported today for the first quarter wasn't quite as good as expected. They missed slightly. And so I think that was seen as a little disappointing. And while numbers maybe were a little bit better than people were thinking, they did guide down. The guidance that we got today was lower than the guidance that we got back in March. And so I do think that there's some pressure on the stock for those two reasons. We also think that, going into the rest of the year, we still will get the benefit of a replacement cycle, which is happening because of how much consumer electronics were bought during COVID, and then the pause after that because everyone had bought consumer electronics. There still will be a driver of that for sales in 2025.
The other part of it was talking about market share loss, and that's irrespective of the macro, irrespective of the tariff environment. Who are they losing market share to, and how do they get it back?
Yes, and so there is some thought that there was some market share loss for Best Buy. I think you can probably see it in appliances most importantly, because if you look at the comments from Home Depot and Lowe's from their earnings period, appliances has been a healthier category for them than it has been for Best Buy. So that's probably one category where there's been a little bit of share loss.
I am curious, though, Kate, when we talk about kind of what the future, the long-term future for Best Buy, I know there's been a lot of talk about, particularly this idea of being a third-party seller in a world where I can go directly to Lenovo or Apple or one of these other vendors and buy that laptop that Alex needs.
Thank you.
And do so, I would assume, presumably at the same price. What's the value proposition? As a consumer, what's the value proposition for me going to Best Buy or BestBuy.com to buy anything?
Yes. So we still think there's quite a bit of a role for Best Buy, just omni-channel retail in general, where you have a retailer that's offering both brick and mortar as an alternative for consumers and online. And I think the brick and mortar is a big differentiator, even when you compare it to the direct-to-consumer piece, because the brick and mortar piece of it allows you to see the technology. So if it's something new and you don't really understand why there's a price differential between a certain TV and an older model of a TV, you can see. Yeah. You can go to that store and figure it out. Yeah. But there's also a service element to it that I think is still really important. And there are things that Best Buy's carrying, that no one else is carrying. They're a little bit more premium. They're a little bit more on the innovative side, certainly different than what Walmart and Target are carrying as well.
All right, Kate, we got to leave it there. Thanks a lot. Kate McShane, Managing Director in Global Investment Research over at Goldman Sachs. Coming up, we're going to break down tariffs and their impact on ports. This is Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Again, more tariff volatility got the S&P holding up just 0.2% higher. But now you have an appeals court ruling for President Trump and his tariffs.
And it gets to this idea here of uncertainty. And if you're a business, how do you navigate this? Are you planning for tariffs? Are you planning for a 10% rate, a 26% rate, or something higher, or nothing at all? What do you do?
But now have we removed the 100% rate? And isn't that a good thing?
I've completely lost track here.
That's fair.
You pretty much need a abacus to figure it out.
We need an Excel spreadsheet for sure on your computer. All right. Well, joining us now to help understand all of this is Ken Britton. He's the CEO of the Port of Corpus, which is the biggest U.S. port for crude oil exports, just completing a $682 million upgrade, making it the deepest and widest shipping channel on the Gulf Coast. Ken, it's really good to chat with you. Thank you so much. I'm wondering how the expansion got done in the middle of this uncertainty, this turmoil, tariff issues, and also government spending issues.
Sure. So let's go back even further than that. This project's really been in the works for 35 years. It was first authorized, the feasibility study was first authorized by Congress in 1990. First, spending was authorized by Congress in WRDA 2007. And then we didn't get first dollars to be spent until 2018. So we've navigated more than just the short-term uncertainty that we're seeing right now. It's important, though, we have established ourselves over the last 5 to 7 years as the preeminent gateway for exports of U.S. energy. Mm-hmm. So that's both crude oil and natural gas. And so to retain that competitiveness and that position in the world, it was important to get this project done, and we give a lot of credit not only to our staff here at the port, but to our partners in the Corps of Engineers.
Ken, where are the products going right now? Where's LNG? Where's oil going?
So roughly 50% of the products that go out of here go to Europe, and then the rest is kind of spread across Asia and other parts of the world. We actually have one trading partner in Europe, Port of Rotterdam, that gets about 22% of the shipments that go out of the Port of Corpus Christi go into that single port. And that was critical during the time that Europe was trying to make a transition off of Russian energy, for example, in the wake of the invasion of Ukraine.
I am curious, as we kind of move forward, Ken, I mean, we talk about this idea. We have an administration now that has been incredibly supportive of this idea of not just energy independence, but the idea of being able to export the excesses that we have. The previous administration, for the most part, also was supportive of that as well. I am curious about the other side of the world, though. Given some of the geopolitical uncertainties out there right now, is there any concern about a threat to some of our partnerships and deals that we have with our overseas companies and countries?
So, of course, there's always, anytime you increase the political uncertainty around the world, you create that kind of concern. But the fact of the matter is demand for U.S. produced energy, and particularly Texas produced energy, remains strong around the world. And at the end of the day, that's what's going to trump all of your other concerns around politics. I don't see any slowdown right now. We're up about 5% year over year through the first 4 months of the year on shipments through this gateway. And so I think our customers, 94% of the products that move out of here are liquid energy. So I think that demand remains strong throughout the world.
And how are we doing with regards to just sentiment overall in your world, amongst your peers overall? Are you feeling optimistic right now about where things are going for your business long term?
So I think generally, particularly here at this port, which is an energy port, I think we still remain pretty optimistic. The demand not only in the U.S., and you are seeing tremendous increases in demand for U.S. energy in the U.S. because of data centers and AI and things such as that frankly, traditional fossil fuels may not even be able to satisfy. So that's why it's important to continue to develop clean energies and those kind of things. But I think in other parts of the world, that demand also continues to remain strong. Any uncertainty you create, though, that may tip us into any sort of recession or downturn, then obviously starts to impact that.
I love that you brought up the intense demand within the U.S. There has been a narrative, in particular when it comes to LNG. More we export, the more prices rise here in the U.S., which makes natural gas within the U.S. less competitive. And we need that cheap gas. That's what's going to make manufacturing really work here. What have you noticed?
Yeah, so here in this port in particular, so the Port Authority, which is a small piece of the puzzle down here, we have about 200 people managing about $1.5 billion worth of infrastructure and assets. But our customers are fairly large. And so you continue to see the pull on energy from customers here and tremendous demand overseas. I think time will tell, but markets for LNG, for crude oil, those kind of things, they're set on a much bigger scale than just what's going on here. Right now, there is adequate supply to meet the demand around the world. But if you look at future projections, I think you can see that starting to tighten up over time. And then you could reach a point where, yes, you're dealing with higher prices that are being set on the world market, but that are impacting investment here. We've had $65 billion of private investment over the last 10 years, and it was brought here because of cheap natural gas.
Yeah, but to that point, Ken, part of that competitive advantage, though, has been lower gas prices. And then even when you take into account the shipping fees, it's still a lot cheaper than getting gas from, say, Japan or Qatar. Do we maintain that competitive advantage?
I think we do, at least in the near term, and I don't know what you call the near term, right? Next 7 to 10 years. And then after that, we're going to have to, I'm sure there will be some decisions and some rationalization that are going to have to be made.
Kent, really appreciate you taking time for us. Kent Britton there. He's the CEO of the Port of Corpus Christi. Of course, as we keep an eye here on U.S. economic conditions and we keep an eye on the situation with regards to our trading partners and the breaking news that we had at the top of the hour, a U.S. appeals court temporarily putting on pause the ban on some of those Trump tariffs. Peter Navarro, now the White House trade counselor, speaking to reporters just a little while ago, saying that they've already gotten calls from countries this morning for talks to continue. And he also said that the court told us to, quote, go do it another way, and that he is expecting to hear in the next day or two from the U.S. Trade Representative Jermaine Greer on this. So a lot of moving parts going on right now when it comes to what's going on with trade. We'll stay on top of that as we continue to count you down to those closing bells and take a closer look at some of the big movers of the day, and that includes Salesforce. Those shares slumping despite a relatively decent first quarter earnings report. We're going to explain why in our Stock of the Hour. This is Bloomberg. All right, let's take a look at our Stock of the Hour, Salesforce. The share's down almost 4%. Now, this is largely because of that $8 billion deal the company has for Informatica. They did release earnings last night, and their annual recurring revenue from the division that includes AI-focused tools, well, that actually crossed $1 billion in the most recent period. Mandeep Singh joins us right now from Bloomberg Intelligence to talk about that and really the broader AI trade here that we got a glimpse of it from Salesforce. We got a glimpse of it, of course, from NVIDIA. And at least based on my interpretation, it looks like the AI trade is still intact.
It is. And look, even with Salesforce, I know the stock is down, but the overall read-through around AI was pretty good. And Agentforce, which is their AI offering, now crossing $1 billion. And the reason why they were impacted is Salesforce is a seat-based model so far. So, you know, if you're adding more employees, they're going to charge a subscription per employee. That is shifting now. In the world of AI, you're not going to be adding a lot of employees. You are consuming the tools like ChatGPT, like agent tools that they are talking about, and it's so very consumption driven. And that's where, you know, obviously they don't have their own foundational model, so they're building on top of someone else's foundational model, but they are the kind of the record that everyone needs when it comes to training the AI. And in the case of software, if you are the system of record, that's a pretty high moat because the large language models can't really train on the customized enterprise data that you need for your AI to work. And so that's the playbook here, and that's why they're acquiring Informatica.
I mean, yeah, but RBC downgraded that, talking about execution risk because of the Informatica deal. What do you think?
Acquisitions are hard to justify. You know, when you're making multi-billion-dollar acquisitions, and with Slack, they really overpaid. In this case, I would argue they're not overpaying. Like, it's not a very expensive deal from a multiple perspective, but $8 billion is still substantial. And the synergies, I would say, there are not much cost synergies that you are going to see. Revenue synergies, yes, there will be inorganic contribution, but you're not going to see synergies right away.
I mean, one of the big sort of wild cards in all this, not just for Salesforce, NVIDIA, but really the tech space writ large, is right now trade policies. And not just tariffs, but of course, a lot of export controls, a lot of controls with regards to the use of intellectual property by certain nations. And I'm wondering how you model that in. We got a scare yesterday with some of those chip design companies, software companies, and the idea that they may not be able to sell to China. Jensen Huang spent a lot of time in their 10Q discussing the idea of China, at least in his view, potentially just not being a market if these restrictions stay in place.
Yeah, I mean, look, if you're a company that has got China revenue exposure now, I mean, supply chain is a different aspect, but revenue exposure, overnight, in the case of NVIDIA, we're talking about that revenue going to zero. So in the case of Synopsys and Cadence, yes, it has come down from 20% to 15% to 10%, but it's still 10% of the revenue. So then you have to find, other places where you can either sell more, or I don't know how you make up for that revenue overnight. And NVIDIA did end up doing that last night. I don't know, somehow they managed to offset all that revenue they wrote down. But it's very hard for a software company to do that because it's, again, a subscription model.
What has been your overall takeaway then as we wind down earnings season? Like, what's the one thing Mandeep keeps thinking about?
I think that whole sovereign AI wasn't really that big of a deal so far. But now with Middle East, and Jensen talked about going to Europe next week, I mean, I just want to know what is the interplay between sovereign AI and hyperscale cloud. Because so far, hyperscale cloud vendors were serving all the computation needs, across different geographies. Now with every country developing their own AI, investing in their own infrastructure, what happens to the demand for the hyperscale cloud guys? And I think that's a big question mark in terms of how the infrastructure build out happens in the world of AI.
Which is so interesting because we see that in other sectors too. Like, are we going to have just like a nationalist energy policy, a nationalist AI policy, and then how that winds up actually transmitting itself?
Hyperscalers have 50% plus international revenue.
Yeah.
And they open data centers in all these locations. These are not sovereign data centers.
Interesting, Mandeep. Always good to get the perspective. Super appreciate it. Mandeep Singh of Bloomberg Intelligence. All right, we made it through Thursday. 15 minutes to go. You're taking a look at an S&P. Guys, pretty much going nowhere fast. Kathy Entwistle, Managing Director and Private Wealth Advisor at Morgan Stanley, will be joining us next. This is Bloomberg.
I think it's hard to say whether we get new highs in the S&P at this moment because there's so many cross currents in the market. But I think what we've learned so far is that you're supposed to, number one, find places of diversification, and number two, continue to remain invested. We think AI remains an area of the market that you should continue to invest in and put your money towards.
Gargi Chaudhuri kicking us off to the close over at BlackRock just about 50 minutes ago. An S&P 500 only up about 0.5% on the day. It looked like coming into this morning we were going to have a much stronger rally, partly because of those earnings out of NVIDIA and partly because of what looked like maybe a block of some of the Trump tariffs.
Yep, and then appeals court unblocked the block, if you can say. Potentially it goes to the U.S. Supreme Court maybe. But you're also looking at,
Have you ever seen that show, Rock the Block, where they
No.
Oh, okay. Where they remodel all the homes on the block.
I would love that. Okay. I'm a big fan of that, for sure.
Right. Back to markets.
Anywho, but individually, there are some idiosyncratic stories. You're looking there at Salesforce, Synopsys, which actually withdrew its full-year guidance after the news yesterday that President Trump is looking to block certain chip manufacturing from exports. So there's still this sort of headline risk, but maybe the way you think about it changes on a sector or company level versus a broad index level if we know there are limits.
Absolutely, and we've seen that a lot, particularly some pretty strong gains on an individual stock basis if you look under the hood. And we should point out, even at 5,900, while we're off from those record highs, still a pretty solid bounce back from where we were just a few weeks ago. Kathy Entwistle joins us right now here in Studio 2. She's Managing Director and Private Wealth Advisor with Morgan Stanley. All right, Kathy, it has been a wild ride, to say the least, over the past few months. And I am curious about this idea of where you do look for opportunities in this market, whether that is a play for growth or is that a play for something that's a little bit more defensive and protective. What are you advising people on right now?
It's a great question, and it always depends on where we are in the moment. But what I am advising clients is anytime there is a pullback in the market or there's some downdraft, go and rebalance your portfolio. Take the opportunity of the imbalance in the markets to clean up your portfolio. We're recommending right now growth. We're recommending AI type companies driven by AI. This is a long-term view, and we want to be invested for those opportunities that come along. And certainly we've seen some of that happen already in the last few weeks.
How do you parse, though, the long-term planning, the long-term investing with the short-term noise, which does have long-term implications potentially? Absolutely. And I am curious as to how you navigate that.
Yeah, it's been the same story for a long time for me, for my clients, because we've seen it over market cycles. We do have challenges, but if you time the market, it's going to be tough, right? It's a rough opportunity to try to time the market. So what we try to do is think about the areas of the market that we like. Where is the puck going? Not where is the puck today, and invest clients there. So we do like the growth. We're staying a little bit more neutral on dividends. We do like some mid-cap growth as well. International is much more attractive right now. The numbers are just much more attractive than U.S. And just really balance portfolios out with thought behind it.
In terms of international, where and how aggressive?
We like Europe and we like Japan. A lot of times, a lot of firms will say the allocation should be 20% international. I've always cut it in half. Now I'm coming a little bit more towards that view that international does make sense right now. The multiples are really good, the PEs are lower, and there's really some great opportunities there, so we are adding to our international exposure.
One question that keeps popping up is the dollar and not being able to get a sustained bid, and I'm wondering if your clients are calling you up and finally talking about hedged or unhedged risk when it comes to the dollar.
Talking about that a little bit, and I think people are trying to use things like gold or commodities and real estate as opportunities to hedge the dollar. Not really getting a lot of foreign currency conversations at this point, but it is an issue and it is coming up in conversation.
I am curious about, when we see what's going on with the trade war, and obviously to just over the last 24 hours, a real push and pull right now over whether the Trump tariffs will stay in effect, whether they will be at the heights of what he wants or maybe at the baseline of what he's promised. And it gets to this idea, even if you are a single kind of stock picker, bottoms up type of stock picker, you have to be looking at the fundamentals of some of these companies with trade exposure. And I don't understand how you do that. If you don't know whether Apple's going to be able to continue making iPhones in China, or if you don't know if NVIDIA is going to be able to sell chips to China, et cetera, here, then how do you reliably sort of do that bottom up analysis on those types of names and have some conviction that whatever you model is going to be accurate?
You can never know for sure. Certainly in the beginning, when it was a broad, smack across, the canvas about tariffs and everything dropped, that was an opportunity to take a look and see, okay, what's dropped that really, the fundamentals are still really strong, even if there are tariffs modeled into the formula. And so for what we're doing right now is we're just saying, look, we've seen a lot of this tariff noise just become noise. Investors aren't reacting as fast or as quickly as they had originally because we know that that full tariff onslaught is not going to happen and that there's moderation to it. We still have uncertainty. We still don't know. And I would say that's one of the points I'd like to make. Yes, we've had a full circle from the beginning of the year. We're back to those numbers. We can have pullbacks again if this tariff conversation continues. Or becomes more disruptive. In terms of individual companies, we're not going to know for sure, but you're looking for those companies that have the strong fundamentals, they have the great leadership, they have great corporate cash flow and a good balance sheet, and you want to also think about who's going to focus more on the American trade that is being underlined right now.
What do you do with sectors that could have potential growth but still have headline risk, like manufacturing, industrials, chips, for example, in terms of building stuff in the U.S.? Do you advise clients to take advantage of that?
I do think you do take advantage of any of the opportunities that are out there that are going to fall into this thesis. But at the same time, we have to remember we're long-term investors, and even if it's the next year or two, that's still considered short-term. So if you can see past some of the noise and look for more of where the opportunities are. So for example, we were just talking about AI and growth. that is a long-term theme that's going to play out no matter what happens over the next year or two. Long-term, 3, 4, 5, 6, 7 years down the road, you're going to be very happy if you put your money to work in those type of areas.
All right, Kathy, great to have you. Kathy Entwistle, Managing Director and Private Wealth Advisor with Morgan Stanley, helping us count you down to those closing bells. Just about 3 minutes to go. Stocks in the green across the board, but only fractional gains. The dollar lower, at least based on the BBDXY, by about 0.4%. The VIX subdued, yields down across the curve.
Yeah, you know what? Volume isn't terrible either.
Yeah.
I wonder why. That seems strange on a holiday shortened trading week with some broad news. As the VIX goes down, though, what kind of mechanical buying are we going to continue to see? And does that kind of propel us a little higher? And then do we wind up touching those those highs that we had earlier in the year? Or are we just going to tread water now?
Yeah, and it's kind of interesting, too. We talk about the idea of kind of earnings season, at least the bulk of it really being over with NVIDIA out the way. We do get some earnings after the bell tonight. Kind of second-tier companies, if you will. Gap, Marvell, Dell, American Eagle, Red Robin, Ulta, and NetApp, just to name a few. We're going to have a full breakdown of all of today's market action and full coverage of all of those earnings in our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through to that closing bell with a global simulcast that starts right now. Scarlett Fu in the TV studio, Carol Massler, Tim Stenovic, they're in the radio booth as we welcome our audiences across all of our platforms, including our partnership with YouTube, Carol Massler, on a day where it looked like we're going to have a pretty strong rally, strong earnings out of NVIDIA.
Right.
We had what looked like maybe temporarily a reprieve on tariffs, but some of those gains obviously being given back as we get closer to the bell.
Yeah, wah, right? You know, some data on the U.S. economy, that the economy shrank at the start of the year. We saw weaker consumer spending. There's some different things going on. And then we've got some questions about the president's global tariffs. You know, a court saying, kind of ruling against them, and then the Trump administration coming back and saying, well, wait a minute, they're still in effect. There's going to be some legal action, but again, another level of uncertainty layered on here.
Sometimes I think it feels like you need a law degree to follow what's happening when it comes to what the different courts are saying at this point. That said, I think it's fair to say that traders didn't necessarily buy the reprieve because of the way that we saw futures fade late yesterday and into the trade today, given that we didn't have any new news. I mean, we went into the trade today thinking, well, look what NVIDIA did yesterday. That'll give some juice to the trade today. And also look what the court did. And you saw late yesterday that stocks were higher in some cases by more than 1.5%. That just didn't hold.
Anything that goes to the courts, I feel like investors just need to price in that this will take months, if not longer, for us to get any kind of resolution. So you don't really have any new catalyst. You just have, let's continue to move forward with the uncertainty that we have grown accustomed to.
Some decent gains today out of names like NVIDIA, out of names like Chevron, but that's being countered by some significant drops in names like Netflix and Salesforce. The net effect of it all here are fractional gains for the market here on this Thursday afternoon. The Dow Jones Industrial Average closing higher by more than 100 points, or about 0.3%. The S&P 500 up about 24 points, or 0.4%. A similar percentage move higher for the NASDAQ Composite, and the Russell 2000 adding about 7 points, or 0.3%.
All right, folks, to the S&P 500. You've got still, though, most names in the average higher, 355 to the upside, Scarlett, 144 to the downside.
And we kind of have a reversal from yesterday in that you look at the IMAP and pretty much everything is green. Real estate investment trusts up by 0.9%. Healthcare, utilities, each gaining about 0.7%. Those are more defensive sectors. The weak link is communication services, losing about 1/3%. Industrials and consumer discretionary also laggards here in that they've gained the least.
All right, quick check on some of the gainers. NVIDIA on that list. It was a top gainer in both the S&P and the NASDAQ 100, up about 3.25%, well off its highs intraday of about 6.5% to the upside. We broke those earnings yesterday. You guys know the story, but we got some NetApp earnings crossing as well.
Yeah, let's take a look here at NetApp crossing the wire right now. The company saying that for its fiscal fourth quarter, adjusted EPS did beat $1.93 versus street estimates of $1.90. Revenue relatively in line with estimates at $1.73 billion. And here's your forecast going forward here for the company. The company says that it sees 2026 adjusted EPS in a range of $7.60 to $7.90. The street on average looking for $7.71. Net revenue guidance, $6.63 $6.3 billion to $6.88 billion. Not quite sure what that compares to with regards to street estimates here, but no real movement, at least initially here in the shares.
All right, we'll keep an eye on that one. I mentioned NVIDIA, of course. They eased concerns about China, upbeat sales forecast. So again, that went up 3.25%. Elf Beauty off and running, up 33% at its highs today, folks, finishing the day with about a 23.6% gain. Elf agreeing to acquire Hailey Bieber's beauty brand Rhode for about $1 billion. So again, some enthusiasm in a big way in that one. And then United.
Did Justin Bieber weigh in on that?
No, apparently she celebrated, but by herself last night. This is according to the New York Post.
Oh, no.
Yeah, but this is,
intel.
Thank you. You're welcome. Yeah. This is the Post action.
She's one of those modern women, Romaine. She actually owns this business, does it probably on her own. Doesn't need the hubby to weigh in. Just saying. Oh, quiet. All right, United Airlines up 1.4%. United and JetBlue Airways agreeing to a partnership that will essentially allow travelers to use loyalty points and book flights across both carriers. I don't know.
I love it when Carol doesn't get pop culture.
What do you mean I don't get pop culture?
Tim, you got anything?
What did I miss?
I thought, no idea. I'm not going anywhere with this.
Wait, do you have a Bieber comment?
I got nothing. There was a lot of Wikipedia when trying to understand this stuff.
I've actually used Rode. Have you guys? I bet Alex, Scarlett, you guys have used Rode, right?
I haven't, no.
No, don't know anything about it.
I hate wearing foundation except when I'm at work because we wear so much foundation. And I'm really into the Lady Gaga foundation line right now.
Oh, okay. Well, it's a lot of skincare, actually.
Yes,
My daughter actually got me into it.
But. Interesting. Okay.
Yeah, I don't know. But anyway.
Yeah, okay. I'm going to go with...
Hey, speaking of skincare, we are expected to get Ulta Beauty earnings anytime now.
There we go.
After the bell. Yeah.
A good segue. Before we get Ulta's results, let's talk a little about some of the stocks in the red today. Synopsys down 1.6%. Remember, yesterday fell by 9.7%. The company did come out and suspend its financial guidance for the current quarter and fiscal year after it got a letter from the U.S. Commerce Department's Bureau of Industry and Security about new restrictions on exports to China. The new curbs are part of the Trump administration's efforts to restrict the sale of chip-designed software to China, citing national security concerns, once again down by 1.6%. Uber shares ended up falling by close to 5%, 4.6% or 4.5% to the downside. This as the CEO of Tesla, Elon Musk, confirmed that in recent days, the EV maker has been testing self-driving cars on public streets in Austin. Ostensibly, it would hurt a company such as Uber if people were hailing vehicles from Tesla rather than hailing Ubers. But remember, Uber does have partnerships with many ride-hailing companies, or self-driving car companies rather, including Waymo, in certain markets. They've also been developing their AV strategy, their autonomous vehicle strategy. And years ago, they were working on their own stuff, but then they ended up kind of closing or selling off that unit many years ago. HPQ, HP Inc., the worst performer in the S&P 500 on a percentage basis today, down 8%. Shares fell as much as 13% earlier in the session. The company issued a weak profit outlook. It cut its annual earnings forecast. It cited a weaker economy and also the impact of U.S. tariffs against China. Alex.
All right, taking a look at the bond market here. It was a little uneventful. You saw buying pretty much across the curve. We did get the mixed economic data in the morning, but also then you had President Trump telling Fed Chair Jay Powell, you're doing the wrong thing. You got to cut rates at the end of the day. And you're seeing the market moving on that 2-year down by about 4 basis points, guys.
Yeah, he's been very consistent on that message. All right, let's tell you about the latest earnings from Dell Technologies, of course, making servers, AI servers in particular. In terms of the first quarter, total net revenue of $23.3 billion, higher than what was anticipated, which was $23.15 billion. Adjusted EPS for the quarter, that was $1.55, trailing the consensus estimate of $1.69. As for this quarter, it sees revenue of anywhere from $28.5 to $29.5 billion. Analysts were looking for $25.4 billion, so that is a beat on the second quarter revenue outlook. It also says its AI server backlog has grown to $14.4 billion. Analysts were looking for a number in the neighborhood of $7.9 billion, so that is much better than expected. You can see the shares surging right now, up 10% in after-hours trade right now.
All right, from one stock that's up in the aftermarket, 9.5% higher on Dell, to another one, Ulta Beauty. We've seen this stock also move higher. This after the company sees fiscal year EPS of $22.65 a share to $23.20. Previous estimate that the company had seen was $22.50 to $22.90. Also sees fiscal year operating margin of 11.7 to 11.8%. That pretty much meshes with what the street's expecting of 11.8%. Fiscal year comp sales 0 to 1.5%. Had seen 0 to 1%. The estimate on the street is below 1%. So again, you're You're looking at that stock up about 3.4%. Just a quick check on the first quarter that just happened. Comp sales 2.9%, way above the street estimate of 0.31%. And first quarter net sales $2.85 billion versus the estimate of $2.79 billion. Street estimate for first quarter estimates $580, and this company easily blew that away, $670 a share. So again, that stock up almost 4% here in the aftermarket.
All right, Zscaler, the cybersecurity software company, beating on the top and the bottom line in its fiscal third quarter, 84 cents on the EPS side. Revenue coming in at $678 million. It's also guiding higher for both its fiscal fourth quarter and full year, saying that for the fourth quarter, adjusted EPS will be in a range of 79 to 80 cents a share, a tight range. The street was looking for 70 cents a share. And for the full year, the company says revenue will be in the range of roughly about $2.66 billion. It had seen about 2.64, so a slight increase there in that guidance. We should also point out they are announcing a change in CFO, saying that Kevin Rubin has been announced as the new chief financial officer.
All right, taking a look at Marvell Technology, that stock down by about 5%. Adjusted earnings came in better, and the net revenue estimate also came in better, coming in at $1.9 billion. The shadier part, the grayer area, I should say, is second quarter outlook. So their net revenue is in line with expectations at $2 billion, but plus or minus 5%, very similar to second quarter earnings coming in at 67 cents, plus or minus 5 cents. So giving that wider band. They also have an investor event coming up on June 17. So of course, looking forward to more AI and what that winds up meaning for the company.
Hey, before you just move on to that, I just want to mention Ambarella also, which of course is in the same space as Marvell. Those shares higher as well, up about 5% on the back of their earnings report that just came out here, a beat on several key metrics. Tim?
I'm going to the restaurant industry because shares of Red Robin Gourmet Burger are shooting higher right now, up as much as 25% in the after hours. It's a micro cap, $55 million market cap. The company came out with results that said first quarter adjusted earnings per share did beat estimates. It's a turnaround story right now. The CEO, just in about a month at this point, says still there's a lot of work to be done.
All right, just real quickly, Marvell down almost 5%. Dell is up about 6.2%.
You know, when I first started at Bloomberg, I was staying out somewhere way out in Jersey.
Go on.
And the only restaurant was a Red Robin. I ate there every day.
What did you order?
A burger every day.
And was it good?
Yes, it was actually.
I wonder if, but I do wonder, seriously, I mean, in the press release, they talk about going back to what this brand is known for and rebuilding the brand.
Yeah, just simple stuff. That's what you want. A good meal at a decent price. That's it.
That's what they say their value proposition is.
Yeah. All right, are we done?
We're done.
Okay, good. All right, that's a wrap. Across platform, radio, TV,
Are you sure, Alex?
Bloomberg Originals. Whew, I feel sorry for you guys. All right, that's a wrap. Across platform. We're going to continue. We're over here on radio, you guys on TV. We'll see you again, same time, same place tomorrow.
And our coverage does continue here on Bloomberg Television, a deeper dive into some of those earnings, a deeper dive into tariffs and specifically how it affects the consumer. Matt Kramer, a national products business leader at KPMG, he's on deck. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Another wild day on Wall Street has started in the pre-market, of course, with that news regarding the tariffs, but that quickly got unwound here. Stocks did manage to end the day higher, but only fractionally, about 0.4% gain on the S&P. Similar moves that we saw on the NASDAQ, the Dow, and the Russell 2000 here. But there were a lot of interesting stories under the hood here. When it comes to the software sector, we did see a lot of weakness there, particularly a lot with regards to a lot of these sort of software design companies, specifically in the semiconductor space, like Cadence, Synopsys. That led one of the main indices down in that space. And we also saw a lot of activity in the retail space as well. As a group, that was down about 1%. Some interesting commentary out of companies like Best Buy, out of companies like Burlington and Scarlett. We are still awaiting to hear from Gap a little bit later this hour.
Yeah, but let's keep the focus on consumer-related companies and take a look at e.l.f. Beauty, up 24% on the day. At one point, it gained as much as 33%. Its best rally since 2016. The cosmetics company agreeing to to buy Hailey Bieber's beauty brand Rhode for $1 billion. You also see declines in Uber as well as Lyft. Uber losing about 4.5% after Elon Musk confirms that Tesla has been testing self-driving Model Ys on the streets of Austin, Texas. Tesla is targeting a June 12th launch date for robo-taxis there, and of course, that poses competition for Uber and for Lyft. Now, our top story this hour, with earnings season all but over, policy and economic data take over as the key catalysts driving markets. And so far, what we've seen is uncertainty weighing on consumer and business sentiment, but not necessarily showing up as much in hard economic data. However, today's batch of data reflects the consequences of dysfunction in tariff and fiscal policy. Rising jobless claims, confirmation of an economic contraction at the start of the year due to front-loading of imports, and a steep drop in pending home sales because of rising mortgage rates, itself a reflection of higher bond yields, makes it all the more important that investors separate the noise from the signal.
Absolutely here, and we're going to talk a lot today about the health of the consumer. We are awaiting those earnings out of Gap. Those shares dropped 1% in the cash session. Meanwhile, in the post-market, we're seeing shares of American Eagle move lower by more than 7%. Its earnings are out. The first quarter net revenue coming in slightly below estimates, $1.09 billion. The company posting a loss per share of about 29 cents. Remember, this is a company that did pre-announce. They are providing a little bit of a look here when it comes to what's been going on in the second quarter, saying they do expect second quarter revenue to be down 5%, comp sales down 3%, gross margin down year over year. Gap shares also moving lower here, down about 8%. Their earnings, Scarlett, crossing the wire right now.
Yeah, let's take a look at what happened in the first quarter. Net sales of $3.46 billion, slightly higher than what was anticipated, which was $3.42 billion. In terms of the EPS, 51 cents, beating the consensus estimate of 45 cents, assuming that we're comparing like with like. The gross margin for the first quarter, 41.8%, also slightly higher than anticipated. However, you look at the outlook here, Gap has maintained its full year net sales forecast of a 1 to 2% gain. However, it adds that the outlook does not reflect the potential tariff impact. Curious, because I thought a lot of companies had stopped doing that, where they weren't including the tariff impact. But in this case, Gap saying that this tariff impact is not part of its outlook, but it offers an outlook anyway. Investors punishing the stock right now. It's down 11% in after-hours trading.
Let's bring Matt Kramer into this conversation. He's the national products business leader over at KPMG, which has some great data and insights here into exactly what the consumer is feeling right now. And Matt, I am curious. We've gotten a lot of earnings out of retailers. It's been a mixed bag. Some of these companies reporting pretty decent traffic, if you will, to their stores and their websites. Other companies, not so much. And I am curious just how much of an impact tariffs, or at least the talk of tariffs, has had on the consumer and what they're spending on and what they're willing to spend on.
Yeah, it's amazing to watch this, because our data in our survey about a month ago, really showed how Americans and consumers in particular are in tune with the disruption that's going on around them. I think it really started 3 years ago when the high inflation, spiked to a 40-year high, and they got a lot smarter about how they're making their decisions. So even in our data, we saw 3 areas, not willing to take on more debt, 68% pointing to that, weighing on major purchases, willing to delay auto purchases till they fully understand the tariff impact on pricing, and then being very selective in buying decisions, particularly those that extend them over multiple months or multiple years. So membership subscriptions, being challenged in the data that we're seeing. So definitely an impact, and consumers are much smarter than what they used to be, 3 years ago as to how they manage their finances.
Are you seeing anything in your data with regards to customers potentially pulling some purchases forward? The idea that if you think that, the price of a computer or electronic equipment is going to be higher because of the tariffs down the road, do you go out and buy that now? Is there any evidence that people are doing that?
There was. In the auto category, particularly, they said 17% were pulling forward, rather than holding back. So they are looking for deals. And I think that's the second big theme in our survey data is value is a premium. So it's not the clickbait of, if you bought this, would you also like to buy that? They're looking for the clickbait of, what's the digital discount that I can get right away? And, they're making decisions on, I'd rather have ad-supported TV rather than paying extra for commercials. We're seeing even education being challenged on, do I need higher education? Shopping, trusted areas and categories that used to be extremely loyal, like insurance and banking, coming into question as to, should I change based on, high fees, or just much higher rates than what I'm seeing in the market. So some pulling forward, but I'd say mostly, sitting back and waiting to understand the full impact of price changes.
Matt, I like what you said about looking for deals and how it applies to things from small items to something as important as a college education. How hard are consumers willing to look for those deals?
Yeah, a lot more than they used to be. And I think this is going to be how it plays out, is just how are companies responsive to consumers, and how in touch are they with consumers as their volumes get challenged? Are they being creative in how they find ways to give savings to consumers in key times, key areas? And right now, I think there's a little bit of a mix of who's doing that well and who's not doing that well. So I think consumers are looking for it. I think retailers are responding to it a bit inconsistently.
And very quickly, how does AI play into that in terms of brands offering the best deals to consumers, making it easy for them to find it versus kind of having it hidden away?
Yeah, this is the big winner in the survey data that we saw is Gen AI is definitely here to stay, and it's beyond the hype cycle. So both consumers and companies saw 45% saying that it's having a significant impact on their day-to-day lives. And I think that's super important for companies to take advantage of that in a couple of ways. One, they've got to get more efficient and cost-effective themselves. So looking at ways to leverage it for efficiencies, but then also using it to understand how their consumer is moving around in their business and how to take advantage of Gen AI tools that can connect the consumer as they travel through different ways that they're shopping them, particularly on the consumer and retail side.
All right, Matt, thank you so much. Really appreciate your joining us today. Matt Kramer is National Products Business Leader over at KPMG. We're going to stay on this theme of consumer spending because coming up, a slew of retailers reporting results ranging from Gap to Ulta to American Eagle. You can see there Ulta is the outlier, up 7.5%. We'll discuss with Deborah Weinswig of Coresight Research next on what's the picture that's shaping up. This is The Close on Bloomberg. A slew of retailers reporting results after the bell, from Gap and Ulta to American Eagle. And you can see Gap and American Eagle down, while Ulta Beauty up almost 8% in after-hours trade. And this follows earnings this morning from Foot Locker, Kohl's, and Burlington Coat Factory. Joining us now to discuss is Deborah Weinswig, CEO and founder at Coresight Research. And Deborah, taking in all of the different retailers' reports, I'm curious which ones stand out to you on the upside and which ones stand out to you on the negative side.
Well, I think that, first of all, thank you. But secondly, as we think about the positive, which I always like to start with, to see a beat to that magnitude by Ulta of 90 cents, I mean, that's like tech stock type of, scenarios. We did see a comp of almost 3%, but the most important thing is they raised guidance, right? Many retailers have suspended guidance. They've put it on hold. I think we were talking about how, Gap is approaching the tariffs. And so it's a very clean number. I think that most of the Gap story looks great, but Athleta continues to really struggle. And, to date, I think it's the degree of difficulty continues to be exaggerated. Obviously, there's a significant amount of newer and stronger competitors. So I think we're seeing the competitive landscape continue to shift. And it's getting even stickier than I think it was before.
I am curious, though, when you look at sort of which companies not only are benefiting, for that matter, getting hurt by current conditions with regards to consumer sentiment, with regards to the economic conditions, but also with regards to tariffs. When you look at the results out of a Gap, when you look at the results out of American Eagle, which we just got, and you overlay that with what we see from, say, a Costco or a TJX, et cetera, what is that telling you about the contours of consumer spending right now?
So I will say, and that is actually the question. So from the beginning of my career as an analyst to today, we've had this idea of this hourglass theory. And so, right, you've got the, luxury, and luxury can be defined in many ways, right? Those retailers up at the top. And then in the middle, right, you have all those middlers. And then at the bottom, you've got value. So that could be an Aldi, a Trader Joe's, right? The discounters, the clubs, off price. And so I think that middle, I was reflecting on this before this interview. I mean, the middle is really getting whittled away in a concerning way almost as we think about the competitive landscape. I mean, I think that's what's happening to Target right now.
So how does where does Costco fit into all of that? Because it does offer luxury offerings in addition to value to its core customer, which we've heard over and over again tends to have a higher income than the overall population.
So that retailer in particular, I think, has both, which is why they've seen the performance they have. They have luxury items, but at value pricing. And so nobody would ever think of them as a middler. And what we're also seeing is those retailers who are really succeeding right now have a very strong private label. So not only are you as a consumer drawn to go into the store because of that, but you're saving money, they're making a greater margin. And we're seeing that the reason you start to visit there more often is also changing. Is we're seeing the greatest expansion in private label in 25 over the last 20 years.
Just real quickly, Deborah, when it comes to something like that's truly discretionary, like say what's the kind of stuff that Best Buy sells, what's the outlook there? Is that going to hold up?
So we've done a very deep dive into back to school. I actually have a presentation this morning, and from all the data that we're seeing, and we do a weekly consumer survey of 4,000 consumers, and we've done that since the pandemic. It's actually since January of 2020. And what we're seeing is that the one category that they're talking about cutting back on is consumer electronics, specifically for back to school. And so I do think that, that could certainly turn around for holiday, but for right now, and we've seen higher prices as well, which I think is also concerning the consumer, and it's very evident.
All right, Deborah, I have to leave it there. Always appreciate you giving us context. Deborah Weinswig, CEO and founder of Coresight Research. We should point out Best Buy did fall about 7% in the cash session. Right now in the after hours gap, your biggest decliner in the after hours trade. American Eagle also lower as well. When we come back, a discussion about crypto. This is Bloomberg. All right, the Bitcoin 2025 conference in Las Vegas was taking place, and all the talk was about all these folks trying to take a page out of Michael Saylor's playbook as they look to build a Bitcoin treasury of their own. The token sitting near a record high. This week alone, we heard from GameStop buying more than 4,500 tokens, and Trump Media raising $2.5 billion in capital to also buy into those digital assets. Joining us right now is a pioneer in this space. William Quigley is the co-founder of the Tether stablecoin, as well as the Worldwide Asset Exchange, and he joins us right now. And William, I do want to start here. I know a lot of people kind of derided Michael Saylor when he kind of pivoted his software company to what has effectively now become a barometer for this strategy. But I am curious about people chasing after it. He did something that was unique, and for the most part, he was doing it alone for quite some time. When you start to see DJT and GameStop and all these other folks come into this space, what is that telling you?
Well, here's what I'd say. You're right. Michael Saylor was really the first big publicly traded company that decided to allocate a percentage of its cash into Bitcoin. I think it was a $250 million purchase of Bitcoin at about $11,000. That was back in 2020. And he was alone for many years, actually. It's only been recently, as Bitcoin has doubled from last year, that people are thinking maybe this isn't a bad treasury reserve type of investment. I'd say this. In terms of which public companies would probably get some benefit of doing it, the most obvious might be something like Trump Media Group, where you have a company that's already strongly positioned in the crypto space. It would make sense for a company like that to hold crypto-based assets. Now, for other companies, having been a CFO earlier in my career, I would tell you it might be a bit difficult if I were holding a position in Bitcoin and it's going up and down, and there are accounting rules about how you measure that. So your financial statements could look strange if Bitcoin doubles and that has a material effect on your financials, and you have to explain that away, or worse, it goes down. So I would say there has to be probably a lot of communication between these companies and the investors who hold positions in those companies, for them to understand what's the logic of doing it and what's the holding period that they intend to hold it for.
Yeah, and particularly when you talk about the big difference between a company that's dedicated itself to doing that and say like a Tesla or a Block that actually has a traditional business and is sort of doing this on the side. But this does sort of bring light, William, to just sort of the broader adoption, if you will, of crypto, and some of this, of course, being facilitated by an administration that's a little bit more friendly to it. And that includes on the stablecoin side, which, of course, you're a pioneer in. Just the other day, we were talking about the potential of a IPO of Circle, which in theory would at least be somewhat of a competitor to Tether. And I am curious that as this world opens up in the U.S., do you see a real winner and losers type of thing, or is this kind of a rising tide lifts all boats?
When it comes to stablecoins, there's so many different types, far more than I could summarize here. But it all comes down to how they're collateralized. Some stable coins are collateralized with fiat, with money. Some are collateralized with other crypto tokens. Some, which haven't turned out so well, have more complicated collateralization where it's hard to figure out what is really behind them. In the case of something like let's say what JPMorgan and B of A and a few other banks announced a few days ago, they're going to have a consortium created stablecoin. That will probably be backed by some amount of the bank's capital, which would make sense. Whether or not I would call that a stablecoin, I don't know, because when we talk about, well, is there going to be one? Are there going to be many? There are going to be hundreds, maybe thousands of stablecoins. And part of the reason for that is when you have a stablecoin, a true stablecoin that exists on a blockchain, it can do things that I think the JPMorgan type of stablecoin will not. I don't think you'll be able to, as a consumer, take that stablecoin out of the banking system and put it on your ledger, your crypto wallet, and do peer-to-peer trading, for instance. I think there'll be a category of stablecoins where you can do peer-to-peer trading, where you can use them for blockchain-based systems like DeFi. And there'll be another category that exists in the traditional banking system. And what they're really more about is just modernizing the SWIFT payment network, which is this 60-year-old system that frankly needed some upgrades. And so I don't think you're going to see like one crypto, one stablecoin just be dominant.
Does that work to just have the major U.S. banks, you mentioned JPMorgan, Bank of America, Citi, and Wells Fargo, pursuing a consortium-issued stablecoin, or do they need to be tying up with the regional lenders who are kind of populating the rest of the country, as well as perhaps some foreign banks, too?
I think it works brilliantly. And if I were someone running one of those banks, of course, I would have done it a long time ago. But that's because I don't think consumers are going to touch this thing. I think it's all about modernizing their back-end system, having real-time settlement, which is still in 2025 is not possible. You can't get settlement instantly bank to bank. So that's what this is about. Whether or not the cost savings from this, which will be huge, get passed on to consumers, I'm waiting to see.
So you don't see any practical application that will be consumer facing at this point on that front?
It would be something like Tether, where you can hold dollars. There's 5 billion people in the world who don't even have access to bank accounts. To be able to hold not just currency, but U.S. dollars would be marvelous. But I don't think what the U.S. banking consortium is trying to do is about that. I don't think it's trying to push stablecoin usage among American citizens, let alone the rest of the world. I think it's more a way to modernize their tech, to give big corporate customers access much faster. I could see a lot of applications in the repo market, the reverse repo market, which is an enormous market. But I think if it were up to me, I wouldn't call what they're doing a stablecoin, because if it's going to be on a blockchain, it's going to be on a permissioned blockchain, which just means a private server. it's nothing like the stable coins you mentioned earlier, like Tether, where you can actually use it in blockchain applications.
All right, good stuff. William Quigley is co-founder of Wax and Tether, joining us there. Thank you so much for speaking with us. Of course, we look at Bitcoin. We also look at the public markets and how they ended the day of trading. You had the S&P 500 gaining almost 1% at the open, and it quickly erased some of that advance. Managed to close still in the green, up 0.4%, but really very, very tame trading in the final 2 hours. Of course, big tech was a source of support for the market today following NVIDIA's latest results, and yields moving down across the curve remain as traders are betting the Fed will cut rates twice this year.
Yeah, it's interesting, too. Keep in mind, we are just a couple days from the end of the month here, so you do get a little bit of reshuffling and things. So it'll be interesting to see the price action tomorrow. We should point out in the after hours trade, Ulta Beauty, that's your big winner.
Yeah, big start
up
today.
9%. Meanwhile, Gap, that's your biggest decliner. This is The Close on Bloomberg.
President Trump pushing Federal Reserve Chair Jay Powell today to lower interest rates in their first in-person meeting since the president's inauguration. Trump told the Fed chair he's making a mistake by not bringing down rates. Joining us now to discuss is Bill Pulte. He is director of the Federal Housing and Finance Agency and chairman of Fannie Mae and Freddie Mac. Bill, it's good to speak with you. As a real estate developer, we know that President Trump is a fan of lower borrowing costs. From where you sit, what is the most convincing argument for the Fed to cut rates at a time when the White House's tariffs threaten to reignite inflation?
Well, first and foremost, inflation's lower than it was the last time they cut. President Trump has been very successful at reducing inflation, and so therefore it just only makes sense that if inflation was higher and they did cuts then, why can't they do cuts now? But to your point, for the last 4 years, at least as it pertains to Fannie Mae and Freddie Mac, inflation has been totally out of control. Mortgage rates skyrocketed. And frankly, people are trapped in their homes with these low interest rates. We need to get interest rates down. And President Trump, I believe, deserves that because he's crushed this Biden inflation.
What level of interest rates do you believe we need to get the 30-year down to in order for there to be an unlocking of the existing home market?
Great question. First of all, I would say lower. But I think you'd be surprised. Even with a little bit of move in interest rates, you'd start to see the trend. And we've seen this with inflation. We've seen it with the inflation trend. Inflation has started to go down. And what does that mean? That means that basically rates should also be going down. And so when you have a Federal Reserve that is basically cutting rates at higher inflation, and then inflation goes down and they don't cut, it's very hard for the housing market to properly function, in my opinion. We have a good housing market. People are optimistic about the housing market under President Trump. But boy, it would be entirely different if we could get that going.
I am curious, Bill, here about what happens with Fannie and Freddie. Investors have been, of course, obsessed with this for, well, a couple decades now. It's kind of hard to believe that it's been that long since they've been in conservatorship. The president, of course, putting out on social media his intentions to actually get these companies back out there. What is that process? Where does it stand right now, Bill?
Well, Secretary Bessent, Secretary Lutnick, and I obviously will be meeting and we'll be coming up with some ideas, but ultimately it'll be the president's decision to do. One thing is clear, and the president's been very clear, the implicit guarantees under conservatorship, as people call it, will be in place, and the mortgage bond market will be very safe. Our number one thing, at least from my perspective, as I would be advising the president, if I were in this case, which the three of us will be talking to him about it, is do no harm. And I think there's going to be a do no harm approach, and we're going to keep those implicit guarantees intact. And I wouldn't be surprised to see mortgage bond spreads actually compress throughout this process. But we'll see.
Do you have any idea what that implicit guarantee looks like, Bill? Is this going to be similar to kind of what we had prior to the financial crisis, where kind of everyone knew the government would backstop, but they didn't really say that? Or do you think we're going to get something that's a little bit more explicit, particularly if we are going to put this back out onto the public markets and give some sort of confidence to the mortgage bond investors that if they are investing in this or investing in Fannie or Freddie, that there is indeed something that's less implicit and more explicit?
Well, we're studying all different things, and obviously this will be the president's decision to make. One of the things that we're studying is potentially going public. Again, this will be up to the president during conservatorship, and that would give obviously a lot of different options to what happens in the future. So, in my humble opinion, we want to stair-step this and do no harm at every phase. And I believe very strongly that the president will do a very safe and sound decision.
If you went public with Fannie and Freddie, would the government maintain a stake?
I think that the president has said very clearly, as he said in his truth, that he would stay overseeing them and that he would be in control. I don't see any scenario where the president isn't in control of Fannie Mae and Freddie Mac. This is a man who understands mortgage rates and interest rates and home buying and construction better than anyone. I mean, he's like the only president, in my opinion, who's been interested in Fannie Mae and Freddie Mac. It's crazy that other presidents haven't been interested in this. You guys know this. There's $7.8 trillion at these companies. I mean, it's almost criminal that other presidents weren't involved in Fannie Mae and Freddie Mac. The only time they were involved was when they blew up. And now we have a president that's actually focused on growing these enterprises, making sure that they're safe and sound, making sure that they're building capital, and we are driving them for operational efficiency, and I think they're going to be safer and stronger than ever before.
But why didn't this happen during Trump's first term, though?
Well, the president, first of all, there was a huge decision made in 2021, which says that the FHFA director can be hired and fired by the president. So if you remember, the last director was actually not in office for the full 4 years. This is the first time that there's been a Trump administration with a fully confirmed FHFA director in the early stages, along with the Treasury Secretary and then the president. So this really is a new thing in terms of the dynamics at play here. But ultimately, I think the president will make the right decision, and it is 100% up to him what he wants to do.
So this idea of keeping Fannie and Freddie both a conservatorship as well as bringing it public, is your position on this that this can be done without Congress's involvement?
Well, I'm saying that we're studying all of these different things, and we're studying that question in particular. What we really want to do first and foremost, at least from my perspective, is make sure that Fannie Mae and Freddie Mac are safe and sound. And I can tell you right now, with the mortgage partnership that we just launched with Palantir the other day to root out mortgage fraud, we've been criminally referring suspects that we believe are committing mortgage fraud. With the cost that we're taking out of the business in terms of DEI and climate, we've saved hundreds of millions of dollars at these companies. I think their earnings potential is tremendous, and I think these companies one day could be worth trillions of dollars.
Have there been any discussions in terms of how this might get folded into the big, beautiful bill, which, of course, the House has passed and is now moving through the Senate?
I don't want to get any specific discussions, but I would say that is not in my area of expertise in terms of that's not my jurisdiction. What I'm really focused on is Fannie Mae and Freddie Mac driving operational efficiency and presenting options to the president. And he is the best deal maker. He will make a great deal if and when he decides to do that.
So when we get to this idea, though, about just stability in the mortgage market, and ultimately that was sort of what the whole purpose of Fannie and Freddie was back from their inception. And I guess to today, as we get through this process, is there a sense here that you will be able to maintain stability in the mortgage market and obviously, hopefully, get mortgage rates lower than this 7% rate where they're at right now?
The key here from our perspective, from my perspective, from conversations I've heard and seen Secretary Besson in particular say out loud, and I believe Secretary Lutnick feels the same way, is that we can't have any disruption in the mortgage market. There can be no upward pressure on mortgage rates and mortgage spreads. Instead of widening, we actually would like to see them compress. So again, this will all be up to the president, but I'm very confident that the mortgage market will actually be safer and sounder, and that's why we're studying all different ways to make sure whatever is done, if it's done, is done right.
Well, then keeping them safe and sound, the mortgage market, and as you said, also making Fannie and Freddie just more sound themselves here. If they are sort of spun off, if you will, made public, whatever you guys are going to do here, do you think you would actually need to maybe raise the capital requirements on them to provide that level of safety?
I don't think we need to raise the capital, but I can tell you right now, our phones have been ringing off the hook. I mean, people are so interested in Fannie and Freddie. Yeah. It's like, you have a president that's finally interested in Fannie and Freddie. I mean, I can't even believe it, having been in this job. Yeah. I mean, they didn't even see the administration officials in prior administrations at Fannie and Freddie. So I think the demand is going to be insane, and I think that a lot of people would love to invest in this company. Frankly, if I wasn't in the government, I would love to invest in it too, but I won't.
I mean, fair enough. I mean, we know that. We cover this extensively on the show, and we know exactly how many people have been championing at the bit to get a piece of this. Have Fannie and Freddie, do they have advisors working on this right now, or or is it too early right now for that stage?
I don't want to comment on that. I just say that we are studying all different options, and we're willing to talk to anyone and everyone, and we'd love to get input from anyone. I can at least speak for myself, and I can certainly pass along messages from people as well.
All right, Bill, we appreciate you taking time. Bill Pulte there. He's the director of the Federal Housing Finance Agency and chairman of Fannie Mae and Freddie Mac out there on the lawn of the White House. Of course, everyone right now really interested to see whether Trump follows through on that social media post here, the potential for Fannie and Freddie finally, after a couple of decades, to be taken out of conservatorship and maybe potentially put back into the public markets. We want to switch gears from that and now actually want to stay in the public markets, actually, and talk about, IPOs. Believe it or not, it's actually been a pretty good year so far. There have been 94 IPOs in 2025. That's if you exclude the blank check companies. About $12.9 billion has been raised. Now, you compare that to 73 deals raising $16 billion during the same period a year ago. That's actually pretty decent. And more importantly, it actually means that not only are more companies going public this year, but they're also smaller on average. Seth Rubin joins us right now. He's the head of global equity capital markets at Stifel. Talk a little bit more about this. And Seth, I mean, I know there's been a lot of talk about how capital markets have just kind of been, ho-hum this year. But when you look under the hood, there has been a lot of activity. I know some of that has been more recent, particularly with eToro and a couple other companies coming to market like Mountain. Is there a sense, though, that there is more confidence out there right now for these companies to finally throw their hat into the ring?
Yeah, thanks. I think there is, but I still think we're in a market where we're trying to figure out, frankly, what that means and who the IPO market is most appropriate for right now. I think we always sort of cycle back to thinking about the biggest, buzziest companies, and those are the ones that are going to have to open up the market, and we're waiting for these mega caps to come and really free up the capital. But as you said, if you look at the core of the market, in fact, 6 of the last 6 deals that have been done successfully in the U.S. IPO market were all SMID caps, right? And that's sub $5 billion market cap, and they're all trading up. And investors are looking and saying, this is a great way for me to generate alpha and to be back in the market buying new issue, because that's where a lot of the growth is coming from. So we're very bullish on the SMID cap sectors within, the IPO market and how that rolls out, and not necessarily just waiting on the biggest household names.
How does the tariff situation, the timeline with, the 90-day pause, for instance, on the Liberation Day tariffs, the 90-day reprieve on the China tariffs, how does that play into the timeline for when companies decide to go public?
Yeah, I think it's funny, right? Because if I would have prepped for a tariff conversation yesterday, it would have been different from the conversation that we're having today. And we all know that might be different from the conversation tomorrow, and certainly different from the conversation in 30 days. So I think it adds a level of volatility in the market and just a level of uncertainty. But I do think that investors believe that the worst case scenarios are behind them. Right. I think the market believes that, we've got a functioning capital markets, that the government will keep and do everything possible to keep it as a functioning market. But one of the reasons that the IPO market has been much slower to rebound than the public new issue market is because it takes time, right? You've got a plan. And so it is hard to say, hey, this is what is going to happen in 30 days or 60 days or 90 days as I look to plan my business. A huge part of the market right now is, frankly, new issue coming from IPOs that came in 23 and 24, where sponsors and private equity funds and whatnot are saying, look, we've got a pretty good underlying tape here. Volatility's dipped down. It's a good time for me to start to monetize those assets and get some liquidity into the market.
How much of a logjam is there from that period, Seth?
Yeah, I think there's a very big logjam. I think there's 2 logjams that we're talking about, right? There's a big logjam in the public market for companies that came public over the past 2 years with a view that 2 quarters, 3 quarters, 4 quarters of beat and raise results. We'll be back in the market. We'll be able to bring in more liquidity, and we'll be able to get some capital returned to our sponsors, whether it's private equity or venture or founders. So I think there's a big backlog there. And as we've talked about on the private company side, that backlog continues to grow in terms of companies that believe their North Star is the public market. And so we're starting to see that ease. We're starting to see it open up. But I think we've got a long way to go before we see any easing from that backlog.
Seth, so as we get deeper into this year, and I don't want to get too into politics, but there's obviously been a lot of volatility, a lot of concerns that have driven what we're seeing in financial markets, or the lack thereof here. How much confidence, though, do you have right now, not so much in stability, but at least in enough clarity where companies will have enough confidence, the bankers will have enough confidence, and investors will have enough confidence to continue sort of bringing these new issues to market?
Yeah, look, I think it's evolving on a day-to-day basis, and it's why the public companies have such a better position, right? The existing public companies, even if their stock's been beaten down, even if they've got an upside-down capital structure, they know they can get to market quickly. Whereas if you're working on an IPO, even if you had done a lot of work over the past couple of years, it's still a 30, 45, 60-day clock to turn back on and really get ready for market. So I think that the lack of long-term visibility is absolutely holding certain companies on the sidelines. On the other side of it, as we're out with investors, we know that there is huge demand. So right now, demand is outstripping supply.
Yeah.
Investors are looking and saying, we've got a chance to put more money to work.
Seth, I know you must have heard our conversation with the FHFA director, Bill Pulte, before you came on, and he was talking about perhaps bringing Fannie Mae and Freddie Mac public. How meaningful would that be? How much of a boost would that give the IPO market?
Yeah, I think those companies, it's a bit idiosyncratic, right? They're massive companies. I think that, I wouldn't want to be a small cap or a micro cap company out trying to raise money on the exact week that a Fannie or Freddie is coming, because I think it'll suck up a lot of the oxygen in the room. But frankly, as I just said, 6 of the last 6 and 7 of the last 8 really high quality companies between $1 billion and $5 billion market cap. So that's the strength of the market. It's a big part of where we focus. It's a big part of, frankly, where we're hiring and continuing to grow and focus on that market. So I don't think one large deal out there or 2 large deals out there is necessarily going to change the tone.
All right, Seth, really appreciate your joining us. Seth Rubin is head of global equity capital markets over at Stifel.
All right, let's push ahead to what the markets are going to have their eyes on over the next 24 hours. That includes some economic data out of Europe, inflation data, Scarlett, Germany, Italy, and Spain. But the big inflation data is going to be back here in the U.S., 8:30 a.m.
Yeah, we're looking for PCE price index coming out at 8:30 as well. We're going to get a read on consumers with personal income and personal spending.
And we're also going to get another read on consumer sentiment.
Yeah, this is from University of Michigan, and we know that the data on the soft side, the survey data, has been fairly soft. We'll see how that shapes up.
We're also going to hear from more Fed speakers. That includes Mary Daly and Austin Goolsbee over at the Chicago Fed.